All right. Good morning. Good morning. We have Mish Schneider from Market Gauge, always giving us great information on the markets. And we're not going to ask you about Disney World, okay? So the market's at a really interesting point here, coming up with the CPI number. We've had some declines, but still the buy the dippers are out there. You just can't kill this market mentality, Mish. What's your take on really the been down in the S&P 6 out of the last 7 sessions?
Well, the big down, but really, if you think about it, about a 5 or 6% correction is really kind of normal in any market, certainly in a bull market. And as much as I hate to label the market bull or bear, I kind of like to think about it from the first 6 months to what's going to happen in the next 6 months. And I don't know if we necessarily have all that information yet. So right now, the market is still living on the fact that it's absorbed every single bad news, right, that can be thrown at it. And people still want to be invested in the market. The retail space is heavily invested. And then you have your perma bears out there who keep scratching their heads going, this can't be, nothing makes sense. So this has been a year where price proves out to be the most and only important thing. And all of the analysis and what if and if this, then that, you could throw that out the window. I mean, that's really, I think, the bottom line. Of course, I have my own analysis, but I'm not really going to make a move unless I see things set up well. And that's kind of how it goes. So first 6 months, right, growth, tech, all of that was the big thing. And the next 6 months, my prediction, already we see oil and gas going up, and I think we may have talked about that last time. I had already gotten into oil. We've gotten into gas. So that energy space is big. I think other commodities could start booming a little bit more as people got too complacent on inflation. And I think that growth will mute more, not necessarily crash. And we may see more value type plays coming in as people start to switch from,
Yeah.
hey, we just want to spend money all the time, to maybe we should just spend money more on what we need.
I don't really see how you could be a perma bear because there's so many sectors that are doing well. You know, the housing sector, the industrials, Caterpillar, I think was up 6, 7 points yesterday. So there's always this rotation going on. Well, yeah, maybe we're coming out of this, but we're going into this. So, it's just not a sell everything market. But is there any sectors like Dennis, tried a trade on Capri last night ahead of the earnings? I don't know if you hold that, but like, is there anything waiting to go that really hasn't that you're keeping an eye on?
Well, I do believe that there are still some industrial type materials that are lagging behind all the money that's being spent by the government to support manufacturing in the United States. What I've been sort of affectionately calling the things that make the things that make the things. So that's really where we've been looking at, which includes some base materials like metals, like steel, which has gone down a little bit because of China. But nonetheless, people need steel, they need copper. I think some companies like Dow Chemical and International Paper, all these companies, we actually are long a few of them. Chemours, these are the things that actually make the nuts and the bolts that will go into all of this manufacturing. I mean, this CHIPS Act, obviously, Chemours is a kind of an important little company that nobody really knows about because it makes the coating that goes on every chip. And they have,
Really?
yeah, and they have, it's like a Teflon coating, but it's not Teflon.
What's the
That's
symbol on that, Mish?
CC. And if you take a look at it, I mean, it's not a bad looking chart, but it's certainly compared to something like NVIDIA that obviously if all chips use them, and I did some research on that, why isn't that company at $60? You have to wonder. It's trading at like 34, 35, 36. I think maybe coming in today around 37. And so that's really where we're starting to put some money to work in terms of the discretionary. In terms of the actual quant models, I mean, they got into oil, but they're late behind me as a discretionary trader. But they're still in NVIDIA and Meta and semiconductors. You know, a lot of the holdings that we had, a couple of things got a little bit more chopped up in this churn. But yeah, I mean, at this point, it seems like if you really want to think about where the areas of growth are for the next 6 months, particularly as we're going to go into an election year, and this economy has to grow in order to get Biden back into office, which clearly is what people are in his administration are going to push for. What's his big thing? Inflation reduction. Well, we still have high inflation, but he's going to want to put all that money to work that he can in manufacturing, industrial, so that we, in this anti-globalist world that we've been evolving into, become more self-sufficient and less dependent on China, which of course is why they're now forbidding tech investments in China. So that's kind of what we're looking at right now. And I still like gold. I still do. I think it's sold off, but hasn't been killed or anything. And eventually people will realize that it is a safety play and a place to go. But certain things have to happen first, and they haven't happened yet.
Let's, Mish, what are your thoughts here on this recent pullback in the market? So obviously, you were talking about this move to value, which oil stocks had a pretty good week or two. But this pullback in some of the, major tech components like Microsoft is down 40 points in 3 weeks. We've got Apple trading down about 15 points in the last 6 trading sessions. Do you think like the money's just going to fly back into this, or is this something, this rotation going to last, and we're going to start, continuing just to see maybe the mega cap tech take a back seat to value in the second half, or does the money just flow back into these stocks?
Both, if that's an answer. Yeah, well, you can have both. It's just that the velocity of how much money comes back and how much they actually go up from support levels, I think, will be key. So for example, let's take Microsoft. So, if you're looking at Microsoft at around 300, right? Let's see. No,
three and a quarter,
right? To me, if you were first getting into Microsoft at 350, 360, 370, I mean, you had to realize that things were a little bloated at that point, and the rotation was happening. This is why the retail investors are doing so much better than the big hedge funds, because they're watching for this rotation. But if Microsoft gets down to 300, it could sit there and it could trade between 3 and 3 and a quarter, or even 3 and 350, and hang out there while other things, as you mentioned, Dennis, rotate and continue to go up based on whatever the headlines are and what the needs are. So right now we're seeing energy, and there's some real reasons for the energy markets to go up. And natural gas, which I mentioned in the very beginning, right now, last year, Europe got a pass. They had a very mild winter. And now we can see that that may not necessarily be the case because of the whole Nino weather patterns. But besides that, I also read Chai Girl put something out this morning about Germany and low supply. So we still have supply chain. So to me, these big growth stocks, they're not going to crash, but they may not necessarily be the fun that they were from January to July. And by the way, that's evidenced by this 6-month calendar range that we like to use that resets in January and resets in July. In January, Qs, SPYs, all these stocks, they blew out of their 6-month calendar range high, and that's why, one of the reasons why we had this huge rally up. Now, here we are in July, they're under their 6-month calendar range high. They have not broken their 6-month calendar range low. If they do, I probably would get a little bit more negative in the growth. But what has bursted out is a lot of these commodities, and definitely most things in the energy space, including natural gas. So that's how I'm looking at the growth area. I mean, AI, is it going to go away? No. But did it get too much fun at the party? Yeah. They're having a bit of a hangover? Yeah. Does that mean count them out? No. But that may not necessarily be the big place to put money for the next 6 months.
I'll keep calling it. I'm waiting for them to show me the money, I've been saying. But one thing that I'm definitely looking at, and you just pointed to some of the areas, especially in energy, I'm starting to see coal uptick. here, and that's definitely a good one to catch. Stocks like AMR, BTU.
Okay, Mitch, we got CPI here coming in 30 seconds.
Oh, boy. Oh, my God.
Too quickly
Oh, wait,
here.
I'll have a sip of coffee.
Yeah,
right, so-
yeah. You get to sit through this one, Ed. I think we did this with Blue. We're just going to the 1 minute chart here, and pre-market highs 45.16. Pre-market low 92.75, trading up near the highs of the pre-market session. If they really like this number, maybe get to the 45.40 area. There's 3 highs in that area. If they don't like the report, I'm looking for the parallels at the 44.80 area, or we could just chop around and see.
All right, remember expectations.
There you go.
Expectations year over year, 3.3, month over month, 0.2. Let's see what happens when we get this number. What did the chat say? I had asked them. Let's see what the bets
They
were.
like it.
The
They
bets
like
were
it.
hot. The bets were hot, at least from the chat. We'll see what happens there.
Let's see. What are we? I'm looking on my
All right, here we are. We're getting core CPI month over month at 0.2 versus 0.2 estimate right on the dot there year over year at 3.2 versus 3.3, actually coming in light. So you guys in the chat, you were wrong. It happens, man. It happens to us all. We all get it wrong sometimes. U.S. initial jobless claims 248,000 versus 230,000 estimate. So jobless claims getting a little bit of a spike there. Core CPI also coming in light at 4.7 versus 4.8. We're definitely going to be taking a look inside the CPI report. I will look into the report right now to see what's standing out to us. Is it services, energy? Of course, everyone was looking for oil to create a spike here on the CPI report. So let's see what we look inside.
We're getting a spike. Really no reaction down in the market. The pre-market traders bidding it up since that open last night. Pre-market high really in no man's land here at 45 in a quarter. That's your pre-market high. I think with just going with the recent price action, I think this is a big day for the bulls here because you came down under 4,500. You put a pair of lows in at the same area, and you're trying to rebound. Now, as Dennis mentioned earlier, we've had these pops, but we've given them back. So is this enough to turn the tide to turn some of the sellers on straight? That'd be a little bit more aggressive buyers. Well, we've had some aggressive buying. We've had some nice bounces off the lows. So, Mish, really looking at the information here, is this enough just to get the rah buy everything mentality back into the market?
Well, I don't know about buy everything. And again, let's go back to that July range because it's so important. And believe it or not, the closest index to breaking out of it right now, besides the Dow, is the Russell 2000. And we're just about $1 shy of that right now. So looking at IWM, Qs and SPYs are pretty far from those highs. So Qs would have to go back through 384 and SPYs would have to go back through like 460. So IWM is right there. This is exactly why I believe that the CPI numbers, we didn't expect them to be that hot this month because this huge, big run that we've had in the oil really has happened over the course of the last 6 weeks, but it may not be reflected in the CPI until next month. So I think that could be the hotter month. So I'm not surprised at this, but I would say this would be a good opportunity maybe to see another run for those highs, but they may or may not clear while the Russells might, and that completely is why I'm thinking that this could be the next 6 months of things over, paper over things, number one, and we saw that certainly with Apple, and number two is that I think that some of this other stuff is kind of tired and had its run, where there's a lot of opportunity in terms of the infrastructure, because that's what the government's going to push. And let's not get too complacent with inflation, even food inflation, because there's still a war. As far as I know, there's still a war. And interestingly, all of a sudden, these silos around the world, have you read that story, have been blowing up? There was Turkey, and then there was another country, I forget which one, and then today, France. So is that some kind of weird food terrorism? I mean, there's stuff still under the radar that tells me I still think inflation is going to come back. Maybe not to the point that we saw in June 2022, maybe even worse. We don't know. So yeah, I'd say enjoy this rally right now, but don't look necessarily for new highs in the
There's a fade. There's a fade going on right now as we speak. We are 15 handles off the high, so it just feels like there's just like the overhead supply is just a little bit bigger than the underneath demand. But as I said, I think it's you have the technicals. You don't have very often. You have two highs, basically three highs in the same area in the S&P, and then basically two lows at the 4480 area, and it's been nothing but chop in that area over the last couple of days. I think
it's August, but it's also August. I mean, that's the other thing is this is the first August I've actually ever been here. I've always gone away in August, and I've always been happy that I've done that. And this year, we're not doing that for other reasons, have nothing to do with the market. Our vacation will be later on in the year, but still, it's August, and so people are gone. And I think you have to make sure that you understand that the volatility is going to be low, the volume is going to be low. But like I said, watch, and I would even guarantee that the Russells could get back up through the 194.30 level, and I'm using IWM quotes, not actual cash quotes.
All right, so
go ahead.
I've taken a deeper look inside of here and trying to point out to what actually contributed to the rise, right? Shelter index contributed 90% of the rise. Food index up 0.2%. So food and shelter staying up, right? And now if we're going to start worrying about energy, that's where really concerns can come in. But definitely shelter, motor vehicle insurance, education, and recreation increased here. Energy was slightly up. It wasn't a major jump there. So keep your eyes on that. Energy index increased 0.1% here on this reading. And then when we look a little bit deeper, food index is up here. Energy is starting to get the move. Natural gas is actually starting to fall on this report. Natural gas actually jumping in the futures. So next report, what will that show up for natural gas is something to start thinking ahead of. Airline fares came down and used cars decreased. I actually have an image that I wanted to talk about that with, and I'll give a shout out to Reuters, Amanda Cooper on this, and you can see how used cars prices have really started to come down this year. So that's actually helping CPI. So there's a couple of things that we just got to keep watch. The sticky shelter, of course, not coming down, and then will energy increase on the next reading. Of course, we'll be paying attention now to Jackson Hole. That's going to be August 23rd, if I'm to be correct there. So we'll be paying attention from comments, of course, Jerome Powell at Jackson Hole.
And look how wrong people were about a housing crash, Mitch. I mean,
I was one of those. Don't worry. I was one of those.
And logically, we never thought there could be one because nobody wants to sell their house who has a mortgage under 4%. Why would they? Which means that there's still a shortage of inventory. And, people who could afford to pay for houses in cash and rentals, which have also been, as you just mentioned, really high, would also keep anybody who could potentially afford to buy a home more in the home market. And, I'm an old timer, right? And I don't even like to call myself that. But I know that 7 to 7.5% mortgage rates are 5 to 7% is pretty much the average. And the generation that grew up with rates under 4% didn't realize that, oh, wow, rates could go up.
Gift. Absolute gift for people that did that. Okay, Mish, this has been a really nice and long segment here. I think you were on for one of our other numbers, and I cut you off, and I got all kinds of flack for that. But we kept you on today. Mish Schneider, Market Gauge, giving us a just calm, cool, and collected perspective on the markets. We'll be dialing you up real soon. Thanks again, Mish.
Thanks, Joel. Thanks, Mitch and Dennis. Nice to be here.
Oh.